Hello, everybody. My name is Lush Eisner, and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. At the time of this recording, which is the middle of November 2021, we have been seeing some inflation on both sides of the border. We had last week significant inflation reported in the US, and prior to that, also in Canada. So, what can we do about that, and how can we prepare, and what actions should we take in our portfolios? So let me say, first of all, I am personally wary of totally disrupting my stock and asset allocation due to the inflation. I think I've set up my portfolio in such a way that inflation is going to benefit it, and more on that later. But I basically don't want to throw out my entire portfolio just because there is inflation, which has actually been hoped for by the central banks for the better part of a decade. But so, what does rising inflation mean? Well, it very likely means increased interest, which will be the interest rate is going to be raised by the central bank. This means higher borrowing costs, both for us and for the companies that we invest in. So that is going to go directly to the bottom line of those companies because they're paying more interest on the loans they have, and they all do. So I guess the first thing you should do is look for companies that have very good balance sheets and they have very little debt. Secondly, I would avoid buying bonds because existing bonds, when interest rates go up, will take a capital loss. Now, why is that? Very quickly, existing bonds are paying at a certain rate their distributions every year. When new bonds come out after interest rates have gone up, they will be paying higher distributions. So, in order for somebody to purchase the existing bonds, they need to be sold at a discount because of the distributions that they're making being less than the new bonds. So, that is why existing bonds will lose some money, and so they're generally likely to be avoided. The next thing would be try to avoid growth companies. So these are companies that are still growing. Perhaps they're not profitable today, and they have a lot of future cash flows built into their current stock price, and those future cash flows may not be present currently. And so when interest rates go up, those future cash flows get discounted more, and therefore all of the fair price calculations on these companies become less. And therefore, companies that have future expected cash flows tend to take a bit of a hit on the stock price. The next thing that you can do is go for wide moat quality companies. So these are companies that have a special service or a special product which other companies are not able to provide. And so that's called a moat. And as a result, uh, they're, they make it very easy for themselves to compete in the market. And when their costs go up due to the inflation, they are able to pass those cost increases on to their customers. So wide moat companies are great to invest in general, but especially during times of inflation. Now, another thing to look for is for companies that pay dividends and they are growing those dividends. The growth could be anywhere from 2 to 10% a year, but consistent growth. And that growth means that the dividends will be outpacing the inflation that we're seeing, and therefore your cash flow is still keeping up with inflation. The other general sector that I would look for would be financials. So these would be banks and insurance. These have some advantages during inflation and increased interest rates. So banks are getting a better spread between the interest that they're paying on the savings account and on the interest they're able to charge on mortgages. The higher the interest rates, the bigger the spread. So instead of paying 0 or 0.25% on a savings and then getting 2% on a mortgage, they might be getting a 0.5% or 1% on the savings, but they're charging 4 or 5% on the mortgage. So the difference between the two just becomes better for the banks. And for insurance companies, they have to, by law, invest the premiums that you're paying them for the life insurance. They have to invest it in a relatively safe investment that pays them interest. And with interest rates being low, they weren't getting very much. But as interest rates go up, there's going to be a better return, and that goes straight to their bottom line. The other types of investments you might want to look at during inflation and higher interest rates would be commodities. So everything from gold, silver, oil, copper, all of those things, including lumber, they tend to go up with the price of inflation. So commodities in general are a good way to go during inflation. Real estate is another asset class that you might want to look at because the real estate will also go up with inflation. But you might be careful of using real estate investment trusts because they tend to have quite a bit of debt, which the increased interest rate is going to penalize. So something to be on the lookout for. And then utility companies, electricity utilities, for example, if they are government regulated, are able to go to that government and say, our costs have gone up, and the government will generally allow the inflation to be built into the pricing for that utility. Again, be aware that utility companies may have quite a bit of debt to have built that infrastructure, and therefore the increased interest rates are going to harm them. The last asset class I would look at is gold and crypto, which I sort of group together, even though some people may disagree. And these are sort of a diversification from the stock market. And so they simply work differently. So gold is a fear investment. So when the regular stock market is having problems and inflation does tend to scare people because of the increased cost to most companies, then people start selling out of the stock market and they either go into bonds, which they probably will not in this case, but they will try to go into the perceived safety of gold. Now, do keep in mind that gold actually is neither a great inflation hedge nor is it safe. It is actually quite volatile. Crypto is in that same class. It's quite volatile, but because there's a limited number of each coin, at least as far as we're told, so this doesn't allow for additional ones to be created as it's possible with today's dollar and other currencies. And so that prevents inflation in the crypto coins. On the downside, there's no underlying intrinsic value to crypto. And so to me, it's a bit of a speculation, not an investment. But as far as it behaving differently than the stock market, that is one thing to go for if that's your thing. So we are expecting in Canada to get interest rate increases as a result of the inflation. Uh, they could start as early as February 2022. Central bank said perhaps April. and some experts are building in even 8 1/4 increase of interest in 2022 and 2023. Whether that will actually happen, I'm sure will depend on what inflation does. The other impact of the increased interest rates, of course, is higher mortgages, both variable initially, and when the lack of bond purchasing by the central bank starts to impact fixed rate mortgages as well, you're going to see increases when people are renewing their fixed rate mortgages also. So there will be some impact to real estate. I also don't think it's going to be anything tragic, but the inflation is something that the central banks are mandated to keep between 1 and 3%, and so they will start increasing the interest rates, and that is something that's going to affect the mortgages as well. The last thing to be on the lookout for is something called stagflation, which is a combination of the words stagnation and inflation, and that is a rare but dangerous occurrence when you have an economy that is not growing, but you have inflation. So normally you would have inflation in a growing, overheated economy, and then the central bank would raise interest rates to take the economy off the boil. But if the economy is not growing, but we are also seeing inflation, that becomes a dangerous thing because there's not that much that can be done from a central bank point of view, because raising interest rates would actually slow the economy down further. This is not something that most economists are seeing in the future, but it is something to be on the lookout for. What is likely to happen is for the inflation to come down some, because some of the increases in prices are being caused by the slowdowns in logistics and the supply chain. And as those problems get resolved, then some of the inflation will go away, but some of the inflation is probably more long term due to all the money printing that had been happening to keep the economy going during the COVID crisis. So I believe the higher interest rates will resolve that. And also do keep in mind that the higher interest rates are just going to bring us back to sort of normal. The interest rates have been at an emergency low for a very long time. So by raising interest rates, even those 8 times, is simply going to bring us back to kind of a normal interest rate environment. So I don't think anything bad is going to happen. I think all of this is well telegraphed, expected, and already built into the market anyway. So if you have any requests on what you'd like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.